by doing the direct method of the statement of cash flows. So we're going to start with exercise number 19 on page 60. On this one, the following accounting information is from Woodrail Company. And so they're giving you the income statement items, whether they're debit or credit, and then they're also giving you the changes in working capital as to whether or not it's a debit change or a credit change. So using the direct method. So operating activities. The difference, and this is the only section that is different between the direct and the indirect method. The financing section and the investing section are exactly the same under both methods. But under the direct method, it starts with cash inflows. This particular company has two cash inflows. They have sales and they also have interest revenue. Both of those generate cash. So we have associated with sales, collections from customers. Yeah, no colon. So we have $75,000 worth of sales. Is that all the cash that we collected from the customers? Just what we sold? On an accrual basis accounting? No. What else could possibly affect the sales to customers versus cash collected from customers? Accounts receivable, exactly. So the accounts receivable working capital account had a $5,700 credit change throughout the 2013 year. So if it has a credit change, did it go up or down? It went down. So if accounts receivable decreased by $5,700, what did that do to cash? Cash goes up. So you're going to take the $75,000 and you're going to add the $5,700 for a total of $80,700. We also have interest. Collected. We had interest revenue of $4,300. Now what could possibly have affected that interest that we collected? Well, the payable won't affect it. If it had an interest receivable, it would affect it, but it doesn't. And the other thing that I'm looking for isn't in this particular problem either. I just want you to conceptualize what else. Let's assume this was a bond that we purchased. What? Amortization of either a premium or a discount. If that existed, then that would affect cash. Does everyone understand that? Because if we bought it at a discount, then our interest revenue is going to be higher than the cash we received. Because we got the extra revenue by buying it for less than face value. The opposite would occur if we had bought it at a discount. That doesn't exist now. It will exist in a later problem that I do. So interest collected is just the straight up 4,300. Exactly what's on the the account. So that's a total of 85,000. Cash inflows from operating activities. ROM. Then we have cash outflows. Actually, we'll move that down a little bit. Cash outflows. In our debit section here, we have cost of goods sold, we have salaries, interest, and income taxes. Starting with cost of goods sold. What payments are associated with cost of goods sold? And we get that from suppliers. So payments to suppliers. Payments to suppliers starts with the $43,600 cost of goods sold. Inventory. Inventory is related. It went a debit change of $9,800. So if inventory goes up, what does that do to payments now? Remember, we're doing payments, not cash. It increases our payments because we bought more inventory. 9,800. Accounts payable is the other account that is related to payments to suppliers. And accounts payable changed 7,000 credit. So did accounts payable go up or down? Well, you had a 50-50 shot. So you two arm wrestle and figure out which one's right. What is the normal balance in accounts payable? Credit. So if it went 7,000 credit, it went up. Got it? Yes? Okay. So if it went up, what did that do to the payments? Now you had a 50-50 shot. Think it through. If what we owe now in accounts payable is more than we started the year with, did we increase or decrease our payments to our suppliers? We decreased it. So we need to subtract 7,000. And that gives us 46,400 in payments to suppliers. The next item in our list here is salaries expense. So that's payments to employees. So we had 13,600 in salaries expense. But looking at our working capital, we had a $900 debit change to salaries payable. So if salaries payable went down with a debit change, what did that do to the payments that we made to our employees? Went up. So we need to add 900. See how fun this is? This is a lot more fun than the boring old indirect method. No? You guys aren't agreeing with me? It's a puzzle. Now, in reality, if you were ever asked to do this, you wouldn't do it this way. Because in reality, companies have a cash receipts journal and a cash disbursements journal. So you would just pivot table the cash receipts journal, and it would tell you what came from customers and what came from interest and what came from wherever. Okay? You would just pull it from there. You wouldn't do it this way, but we don't have those luxuries. All right? Well, actually, the next one I do is like that because it just tells us payment from where did it come from or to. All right, the next one is interest expense. So, payments of interest. We had $5,400 in expense, and interest payable, the last of our working capital account, had a $300 credit. So, do we understand what to do with that now? Do we add it or subtract it? Who says add? I'm not voting. Who said, oh, see, you fell for my trick. If it has a credit balance, that means interest payable went up, right? Because it's a liability. So if the payable goes up, what are you doing? You are not paying it. So it's a minus. That's 5,100. And then lastly, we've got payments of income taxes.
Can we avoid paying that?
Sure. For a little short period of time. The IRS is very short-staffed right now. They won't even look at your tax return for a couple of years. Yeah, you can get by for a short period of time. The ramifications are awful after that short period of time comes about. So, once again, it's not sustainable. Yeah. All right, there is no payable in this case, so all of the expense is in cash. Now, also, what else could affect this income tax expense? If you remember the chapter that we studied for this last midterm. What other accounts on the balance sheet could affect that number? We'll do it in a subsequent problem, but right now. Yes, deferred tax liabilities and deferred tax assets affect that. All right? Because the expense is adjusted to get to the payable, and the payable is what you actually send in cash. So if there were any deferred tax assets or deferred tax liabilities in the problem, you'd have to add or subtract that. We'll do that in a subsequent problem. But that's it for this one. Add all this up, and we get a negative 69,000 as cash outflows. From operating activities. Subtract that from the inflows, and we get a positive 16,000, which is net cash provided. By operating activities. Everybody understand this so far? Yes? All right. Next problem, same page. 20. All right. On this one, it is literally just giving you the items. So this is back to similar information that you would have in real life from either the cash disbursements or the cash receipts journals. And it is also including some items that do not belong in the operating activities section of the statement. So you need to sort the wheat from the chaff in that case. So let's just go through it. And we'll just take it in order because we'll either add it to a cash inflow or add it to a cash outflow. So item A, payment to suppliers, $31,500. That's a cash outflow. Excuse me. Oh, sorry. I've often wondered what that sounded like on the, because I've done it a couple of times. I thought, but that was interesting. Other operating receipts. Well, it says operating receipts, so that's going to be a cash inflow. So other $1,200. A payment of dividends. Is that an outflow? Outflow. It is an outflow, but it is an operating outflow. No, it goes into the financing section because that's associated with stockholders' equity. Payment of income taxes. Cash outflow, $5,000. Collections from customers. That's our first list. $68,400. Payment for purchase of equipment. Cash outflow? Yes. Operating? Equipment? Investment activity. Part of the long-term property, plant, and equipment section of the balance sheet. The asset side of the balance sheet. Payments to employees. Well, we got that one on the board already. $19,300. Number H, interest and dividends collected. Interest and dividends. $7,100. Because payments of dividends affects accounts retained earnings. All right. This is coming in from our investments and other companies and stuff like that. It's part of the Remember when we started with net income, it would be included in net income, but it would be in operating because we don't separate that out like we do gains and losses. So, other operating payments. Payments of other operating, 900. Proceeds from issuance of bonds, 11,300. Cash inflow? Yes. Operating? Possibly. Could make a hell of a politician one day, Carl. Possibly. No, it's a long-term bonds. The issuance of bonds are long-term liabilities. Long-term liabilities are financing. Payments of interest, however, 8,400 is operating. Proceeds from sale of investments, 6,000. It is an inflow. Is it operating? Where is the investment section on the balance sheet? Is it a current asset? No. Not operating in nature. And then lastly, it gives you the beginning cash balance. So, all right, that's it. Add all this up, you get, the top part is 76,700, which is cash outflows from operating. And add up all the outflows, and you get 65,100. Which is net cash provided, or cash outflows. What's that? Thank you. Inflows. Yes. And then subtract those two, you get a positive 11,600 net cash provided. By operating activities. All right. Let's do one more. A big long, and I'll do the whole statement this time. I'm going to do problem number 12. Problem number 12 on page 71 and 72. So on this one, it's giving you the beginning and ending balance sheet data, comparative balance sheet, for this company, Angel Company. And then it is also giving you the 3-month financial statement as far as sales and just, it's not in any particular order, but giving you down to net income. So it's kind of a single step income statement. And then there's a whole slew of information on the subsequent page, A through F. Some of which we'll need, some of which we will not need. All right, so direct method, we'll start with cash inflows, collection from customers. So the sales equaled $242,807. Accounts receivable went from $24,320 up to $49,320. So it increased by $25,000. So if accounts receivable goes up, what do we do to sales to get cash collected from customers? Down, exactly. So $217,807 is the 242 minus the 25. And that's our only cash inflow. So that's the end. That is cash inflows from operating activities, because there is no interest. There interest revenue. There's nothing else here. All right.
So it's 242,807
minus the 25, which is the increase in accounts receivable. All right. So cash outflows. Payments to suppliers. We have cost of goods sold of $157,354. Inventory went from $31,090 up to $48,590. So inventory went up $17,500. Do we add it or subtract it? We add it. What's the other account associated with suppliers? Accounts payable. Accounts payable went up $21,220 up to $38,417. A change of $17,197. And we subtracted. Because if it went up, we were not paying these people. So that's a total of $157,657.
Which account was the 157?
The 157 is cost of goods sold, okay, off of the income statement. The next item on the income statement is general and administrative expenses. So payments of G&A. And we don't have any G&A payable. So this is a full 22,010. Next item is interest expense. So payments of interest expense. Or interest. Interest is $1,150. However, look at your balance sheet. What might affect the interest that we pay on these bonds? The hint being bonds. There is a discount on bonds payable that went from $2,300 down to $2,150. So if we amortize a bond payable, does that increase or decrease the interest expense? It increased the expense, so it is going to decrease the payment. Does that make sense? Because a discount on bonds payable means that we needed to pay more interest than we were paying in cash. So we increased interest expense. We debited interest expense, we credited the discount on bonds payable, and we credited cash when we made that journal entry. So now we're just subtracting it out. So total, and these are all negative, by the way, of $1,000. The last item on the income statement is income taxes, $13,865. I'm just going to write this to the side. $13,865. What happened to income taxes payable? Well, it started the year at 0 and ended the year at $13,529. That would lower the expense because we haven't paid it yet. All right? What else affects income tax expense? And we already talked about it. Deferred taxes. So there is a deferred taxes payable that went from 510 up to 846. A change of 336. And that also decreased. And if you add all that up, you get 0. So there were no cash payments for income taxes. Does that make sense? Yes? It's a puzzle. All right, if you add all this up, you get a total or cash outflows for operating I don't have that total. Anybody total that on your computer? Those 3 negative numbers? She's got a calculator.
180.
180.
180 and then 667.
667. Okay. Subtract that, you get 37,140, which is net cash provided by operating activities. Investing activities. This is the rest of the asset side of the balance sheet, including marketable investments. Because marketable investments, while the dividends in the interest we receive is an operating, but the actual sale, because we're not a trading company. All right, so marketable investments went from 17,500 down to 83,000. And it says that on A, it says on January 7th, the company sold marketable securities for cash. Bless you. The securities cost $9,200 and had a fair value of $8,600 on December 31st. The dividends and interest are not material. So, how much did we sell them for? How do you compute how much we sold them for? It doesn't say. It just told us how much they were worth at the end of the year. Well, marketable securities went from 17.5 down to 83. So 17.5 and 83 is 9,200. Is that what we sold them for at cost? What else is in there? Look down at the income statement. There's a gain on sale of marketable securities for $2,400. That's a total of $11,600. That's what we sold them for. From sale of marketable securities. $11,600. The next item on the asset side of the balance sheet is land. Land went from 40,000 down to 18,700. A decline of 23,300. And this was for, and if you read item C, on January 16th, 3 acres of land was condemned. An award of $32,000 in cash. Well, it tells us how much we got in cash. $32,000 in cash was received, but how much was net? It says in the income statement, an extraordinary gain on condemnation of land, net of taxes, was $8,560. Add those two together, you get $29,860. That is proceeds from condemnation of land. Net. 29,860. The building equipment didn't change. The building account is $250,000 at the beginning and the end of the quarter. The equipment account, however, did change. It went from 0 to $81,500. And it says in item D that on March 25th, the company purchased equipment for cash. So, payment for purchase of equipment. $81,500. And that's it for the asset side of the balance sheet. Add all that up, you get a negative $40,040. And that is net cash used for investing activities. The last section is financing. That's the rest of the liability and the stockholders' equity section. So starting, we have bonds payable that went from $50,000 up to $115,000. That's an increase of $65,000. So we have issuance of bonds payable. $65,000. And it said on March 26, bonds payable were issued by the company at par. So that's the full $65,000. So this bond discount, this discount on bonds payable, was from bonds that we sold at some other time, not the current sale. All right? Deferred taxes we've already done. There are no more liabilities, no more long-term liabilities. There is, however, a decrease in preferred stock of $30,000 and a corresponding increase of $30,000 in common stock. And if you look, it says on B, the company's preferred stock was converted into common stock at a rate of 1 share of preferred for 2 shares of common. So this is one case where I agree with your author, because your author in their solution leaves that out of financing. You could do it. It'd be perfectly proper to go proceeds from common stock, a positive $30,000, and then right below it, the issuance, the retirement of preferred. But they just put it in a footnote. They just say conversion of preferred to common, and they put the positive and negative. Because it only affects one section. Remember when I was doing last Thursday, which was a long time ago, when I was doing the problem, or Wednesday, Thursday, this is Tuesday, Thursday. If it affects two sections, if it affects financing and investing, you buy a piece of land by issuing common stock, I separate it out because at that point it's two separate sections. But this one I'm just going to leave off. So the last one is that we have declared some dividends. On December 31st it was 0, and at the end of the year it was 8,000. But there is no dividend payable, so we not only declared it, but we paid it in cash. So payment of dividends. Negative 8,000, giving us 57,000 positive. Add up the three items: net cash provided by operating, net cash used for investing, and then this one is net cash provided by financing. And that gives us 54,100 net increase in cash. If we take the cash at January 1, that will give us cash at March 31st. So we started with 25,300 and we ended the quarter with 79,400. Does everyone understand how to do the direct method of the statement of cash flows?